Hello and welcome to Forex.Academy, your #1 website for Forex and crypto education and analysis. In today's edition, we're going to be discussing how is fundamental analysis affecting Forex during COVID-19. There's absolutely no doubt about it. Since the coronavirus took hold in Europe, the United Kingdom and the USA, and to a degree the height of the epidemic in China, where previously markets had shrugged off the disease as being contained there. The way that the markets are now observing fundamental analysis has been completely turned on its head. Before the virus, markets were doing very nicely, with record strong economic growth, particularly in the West, and definitely in the USA, which had hit a record for the lowest number of unemployment, and also stock indices which were at all-time record highs. Within a few weeks, the country had flipped into a state of a record amount of unemployment of over 16 million and growing. It's facing the worst depression in US history. Naturally, the financial markets are in a state of pandemonium, because the situation is almost unprecedented. Of course, we had the banking crisis in 2008, which sent shockwaves through the financial markets, and we had other virus outbreaks such as SARS, avian flu, swine flu, and Ebola, which all caused some degree of market turbulence, but nothing on the scale of what we are seeing at the moment. Normally, financial markets, including Forex, oil, gold, and commodities, turn to stock market indices for guidance because they present a good gauge of economic activity. But of course, while most other countries are in lockdown, the majority of businesses' sectors are closed and economics have essentially flatlined. GDP, which is a key area of fundamental analysis, is now useless. In fact, any economic data releases coming out of major Western countries right now can only tell us varying degrees of catastrophic failings. Where once currencies would rise and fall in exchange rates based on strong data which only fluctuated in relatively small varying degrees, and where markets were able to predict such data releases with a narrow band of expectation. Now analysts are gauging the value of one currency against the next, on which country is suffering the fewest fatalities, and sometimes this causes seesawing of price action on an hour-by-hour, day-by-day basis. As China slowly begins to come out of the virus and starts opening for business, we should not be surprised to see countries such as Australia and New Zealand, who export heavily into China, to be amongst the first countries that start to bounce back from the virus, especially as they are recording lower numbers of deaths at the moment. This would mean that their currencies strengthen against counterparts, and we are seeing that against the US dollar right now. We can see this where 17-year lows for the AUD-USD pair has recovered, and where the NZD-USD pair hit an 11-year low, before recovering to its current position. Countries such as the USA, which was the last continent to be affected, is directly in an area of focus right now because of the exponential death rate and the fact that it is the largest economy on the planet. It might end up being the most severely affected country, both in terms of people suffering and dying from the condition, and also its economy taking a huge hit. This is both in terms of unemployment and its GDP going into minus territory. The thing that is stopping a complete stock market annihilation is the fact that the Federal Reserve acted quickly to slash interest rates and enter into one of the biggest quantitative easing programs in history in order to bolster the finances of small to large businesses across the United States to try and stave off mass bankruptcies. They offered financial relief to the majority of its population. This has helped US stock indices bounce back off their lows and steady themselves to a certain extent, and surprisingly the US dollar index is actually higher than before the crisis. So are people now looking at the US dollar as being a safe haven currency? Probably so. Well, we know for at least the next few months the economic data coming out of the Western countries is going to be bad, with economies flatlining and grinding into negative territory across the board, with gross domestic product tanking in each country. Also, we have seen in recent economic data releases coming from the United States, such as weekly unemployment numbers, which are getting worse week on week. The markets are largely discounting this information, while betting that the US economy will be far better than most in the long term when things start to recover. Therefore, analysts are predicting that all Western countries will record high levels of unemployment and negative gross domestic product numbers. The hope is that these will be short shocks, and that as long as the virus is contained in a short period of time, those economies are likely to bounce back and grow strongly. The big question is how to trade the foreign exchange markets based on fundamental analysis. The best advice we could give is to expect the unexpected, which you should do anyway, but even more so right now. Because we know that all the data numbers coming out of all countries are going to be bad to horrendous, and some of the big players out there will be completely ignoring the data to strategize their Forex turn based on technical analysis only. This would be our best advice to you. Stay out of the market during times of economic data releases, reduce your trading size, and tighten your stop losses. If you enjoyed the video, then please like and subscribe, and leave a comment down below about anything you would like us to discuss in future, or if you have any questions about this particular video. Have a great day.